30 hours every week, and you still don't know. EA drops and the market moves fast. You're reading last week's data. How long does that last? Crude and nat gas telling you a story. Visibility, velocity, that's the glory. One signal every morning before your coffee's cold. Green means go, red means hold. This is road radar, signal every day. Oil and natural gas cleared out of your way. 5 minutes of clarity, that's all you need. Get the rogue method 3, then let rogue radar read the market. EnergyRogue.com.
Hello, folks. Bill and Brian here with our weekly update. Hey, listen, we have been having so much fun doing what we're doing. We appreciate you guys watching. But today we thought it's time to get beyond the headlines. Everything you see right now is headline driven. So today we are going back to the Middle East and we're going to talk about the numbers.
Yep.
Because the numbers will tell you the story. And some of the stories that it's telling us right now are a little bit scary and some are not quite so scary. So let's talk about it. And you might be surprised, out of all this stuff going on in the Middle East, which country's actually the most impacted. It might be just a little bit of a surprise.
Yeah.
So Brian, let's dive into this, man. It's time for us to talk about what are we doing with the oil in the Middle East?
Yep. So this is going to be kind of a lengthy one. We are recording this in early June 2026, depending on when this finds you. So we are talking about the Middle East and the oil reset. You know, the Middle East has had disruptions, conflicts in the past. This one is different. This one is going to result in different things. So we're going to talk about where we are, where we've been, where we are, where we're going, and what it means for the future, because there's going to be a complete reset on what is happening in the Middle East in terms of production and in terms of exports. And something that Bill and I were talking about just before we got started is how much oil gets exported out of the Strait of Hormuz, Bill?
There's about 20 million barrels has been coming pre-war, was coming through the Strait of Hormuz.
And how much oil travels on water?
That's what people don't realize. Everybody keeps calling, well, it's 1/5 of the total oil. Well, when it travels on water, that's mean that somebody's importing it. So you can't look at the total number of the oil production because a lot of people use their own oil. So domestic production takes out of that. So 20 million barrels, there's about 40 million barrels that goes out into the world for imports and export, probably somewhere between 40 to 43, I think, if I remember right.
Right.
So it is not 1/5 of the oil. It is 1/5 of the oil production, but it's half of the oil imports and exports. And that is a significant number.
And we're rounding
That's
it
why
off
this
just
happens.
to make it simple, but roughly you could say that what's being reported is 25% of the global crude supply is impacted, and that's true, but 50% of the internationally traded oil on water, meaning that there's not local resources that can be tapped. Think about Japan. Japan has to import all of their oil and all of their LNG. So that's the reason it's significant. So what's the big idea? Why are we talking about this? The Middle East oil market is no longer a production story. It's a logistics story. The barrels may exist underground, but the problem is whether or not they can move. And that is a classic problem across the globe, not just in the Middle East. But the war has turned the Strait of Hormuz from a shipping lane into a global oil pressure valve. And when that valve tightens, production falls and sometimes will be restricted from growing. Exports have to reroute, freight explodes, freight costs, and inventories become the real shock absorber. One thing that Bill and I have discussed is that the United States, Europe, Asia has been drawing crude out of stocks or reserves
Right.
during this crisis. But what's happening in the Middle East right now with their stocks? They're increasing. So you do whenever this resolves, you will have too much oil in one place, not enough in another, and you'll have a logistics problem to connect those two or to get out of that. So this is what the numbers mean one more time. So in global stocks, we took March of 2026. The OECD stocks were about 2.7 billion commercial crude stocks. So global oil demand is still enormous. OPEC forecasts the global oil demand at 106 million barrels a day in 2026 and 107.9 2027. I would argue those numbers are probably not going to transpire. There's demand destruction because of this. But that's what OPEC
Well,
is
I'm gonna take the opposite side of that.
really.
I, yes, I think it's going to be higher.
Okay. Really?
Yes, and the reason
Higher than
is because
OPEC's numbers? Because OPEC's numbers are usually the higher.
they're very traditionally high. But what I think we're going to see, I think we're going to see demand in places that we have not traditionally seen demand.
Okay, my brain's
So
on fire. What do you mean?
I think Africa is going to be the big thing.
Ooh, yeah.
I think the African continent is going to have a higher demand than what we're looking at. In fact, it's when you start looking at the is it EIA or IE? I never can remember which one it is.
It's
The I
IEA
think
if
it's
it is
EIA,
the international. EIA is the U.S.
but I think if you look at both of them, when they start looking at their demand growth
Mm-hmm.
beyond 2030, it's Africa, and
Yeah.
so, but that's for significant growth. But it's continuing to grow even from now. And so I think that demand could go up even higher. And that is never a sloped curve that is flat. Once it starts happening, the curve increases significantly
Okay.
because demand begets demand, I guess is what I'm trying to say.
Right.
Is the more you get, the more you want.
Yep. Yep.
And so I think I'll go with the 26 number. I don't think I'll go with the 27 number.
Okay. In other words, you think the 27 number still might be too optimistic.
No, I think it may. Yeah, I don't think it's optimistic enough.
Oh, okay. All right. Man, that's a lot
Now
of
let me ask
growth.
you this: if you've been in a let's give it a good example. Let's take 2020.
Uh-huh.
What happened? All of a sudden, everybody hoarded everything because it wasn't available.
Right.
So what happens when something is not available? You either change how you live, in other words, live poorer, or you buy more of it and build places to store it.
Yeah. Well, and part of that resulted in a big industrial consumer wave in
Right.
2021 to 2023. So yeah, that passes the test. So
And then when you have it, what do? You figure out ways to use it.
right, yeah, interesting.
And
I'm
all
not
these
sure I
stocks.
agree. But I think that is an interesting thread.
Well,
Um,
I will grant it is a contrarian thread. I will
yeah,
give you that. But I think it has some history with it. And hey, folks, send us comments. Let us know what you think.
right.
Am I way outfield or closer to second base? Let's see.
Yeah, yeah. Well, we'll have to find out. But
And
that
by the way, for you international field, that was a baseball reference. I'm sorry.
um, but essentially, these stocks give the global markets about 61 days of cover. So that's a
Right.
theoretically comfortable place to live, but it's definitely not enough. We saw this during the supply demand shocks of COVID. So
Right.
let's take a look at real numbers from February and April 2026. This is coming from OPEC reports. And in Saudi Arabia, 10 million barrels a day. In April, 6.7. Iraq, 4.2 to 1.3. Iran, only a little bit of a drop because they're the one in control of the strait. Kuwait took a huge one, almost down
Right.
2 million barrels.
And that's the
UAE,
surprise, I tell you, folks. Kuwait is the one having the most impact. When
yeah.
you look at it as a percentage of the barrels, they're taking a beating.
Oh, yeah. UAE, that's a little bit more than I expected with their access to Fujairah. Um,
Well, I
Oman,
think I think it's
no
the problem
impact.
with Fujairah is that is the capacity.
Yeah, yeah, I think you're right. Bahrain is down, and not a big producer, but still impacted significantly. Um, so you can look at it this way: 66% for Bahrain, um, and gosh, 2 million barrels out of 2.6. That's a lot. But
Yeah.
we can see big change here, big change here, big change here, big change here. All right. So remember these countries: UAE, Kuwait, Iraq, Saudi Arabia. Those are the ones that we're going to be diving into when we look at the post-war production. What exactly happens? Okay. So Strait of Hormuz. What happened? That's the choke point. 1/5 of the global oil trade, or 50% of the global on-water trade, as we talked about. Um, it is trapping oil in the wrong place. So reduced Gulf exports, the Atlantic basin is rerouting, um, going through different routes, sour crude disruption. This this creates kind of a ripple effect. It impacts metals markets. It impacts fertilizer. The sour crude actually hurts a lot of food production and a lot of metals production, and it's not something you see right out of the gate. But the market essentially breathes this through a straw, and the market's not broken, but it definitely is reorganizing. And to give you an idea, is let's go ahead and look at the marine traffic. This will bring up current day. Um, Strait of Hormuz, just for everybody watching, is right here. You've got UAE here, Saudi Arabia, Iran, Iraq, Kuwait. And you can see Kuwait, that's the only way that they're going to get out.
Right.
So Saudi Arabia has another pipeline that they can take from this side over to this side and deliver via the Suez Canal. And the Bab el Mandeb, straight down
Right.
here, is these are the three oil constraints: Suez Canal, Strait of Hormuz, Bab el Mandeb. And what we will see is a big wave of infrastructure projects. But when we're talking about these countries, Saudi Arabia, they were producing 10 million barrels a day. And with their pipeline, their east west pipeline that goes from here, and I'm drawing a straight line, but it's not straight. This line was actually bringing NGLs over to the strait. Well, they idled that and throttled back their NGL production and turned all of it going this way. So this was a bilateral pipeline that was delivering some this way and some this way on predominantly NGLs, but it was switch. So,
Yeah, and it's about 7 million barrels a day of capacity. And
mm-hmm,
so and and 7 million barrels is its top. It runs probably closer to 6.3 to 6.5 because that's where you need to operate the pipeline. The problem is once they get over to the Red Sea, they've got to their capacity to offload is only about 4.5 to 5 million barrels a day.
right.
And so, but what it does do is give them access to storage over on that part of on that side of the country.
Yeah. 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 So in April, production fell to 6.8 million barrels. So you can see about 3 million barrels impacted. And that east-west pipeline to Yanbu is to the Red Sea. That's a partial bypass. So they're able to curb that. So the strategic view is Saudi Arabia becomes the most recoverable producer. They have the best capability to lever up and lever down. Because when we're looking at the post-war view, we have to look at who can come up and how quickly. Do realize this. There's about 1 million barrels a day. So when we go back to looking at the total of the supply, you got 3.3, what is that, 6 here, at
And about
8,
10 million barrels were shown there.
10. So out of that 10 million barrels a day, there's roughly 10% or 1 million that is not going to be recovered. That's productive capacity because of reservoir losses in the field that we're not going to see. So when we are looking at Saudi Arabia, they have the biggest capacity to curb this because they have storage built, they have the east-west pipeline, and they're able to shift a lot of things to where their impact out of that 1 million barrels a day is not going to be very large. But that's the strategic view there. Iraq, the pre-war position, they were producing over 4 million barrels a day with core export destinations like India, China, South Korea, Europe, United States. And Asia is the primary purchaser out of that base. And their production fell by roughly 1.4. And Iraq is highly vulnerable because of the southern exports. They're able to do some through northern exports, but those have already been operationally exploited. They're one of
Now
the most
it's a small
exposed.
pipeline. I think it goes through Turkey, if I can't remember how that works.
I think you're right. I think you're right. But after the war, Iraq faces the slowest export normalization. So
Yes.
it's going to take them a while. Iran, well, Iran, they haven't been as impacted. And the reason why they haven't been as impacted is because they are holding the Strait of Hormuz. They've been impacted some because of the US naval blockade, but most of their production and exports haven't been hit. But one thing to realize is producing 3.2 million barrels, their native demand is 1.8. So inside the country, you can think about it as, well, they're only exporting 1.4 million. And that gets back to that export grid of seeing Saudi Arabia at 3, Kuwait, uh, Kuwait at 2, UAE at 1. I mean, they're taking a big hit. But
And
Iran's
think about this: Iran is a country of 90 million people,
mm-hmm,
and this is how much their oil production is.
yeah,
And it's not because it's not because everybody's driving a fancy car. It's because they're willing to. And so the 1.4 that they're exporting is bringing real dollars into their economy, and that's what the importance of that export is.
right.
And so it's a little bit it's got more of an economic play there, and the fact that it's outside money coming in a very large country with 90 million people. And
Yeah.
I'm pretty sure
I mean, it's a
I
very
don't know what.
large landmass. I mean, you can look at the landmass right here. It's a very large landmass, right?
Right.
And you got 90 million people. That's a big country. Um, but
And some of their exports were going off into the north to Russia, if I remember right. They're in the Black
well,
Sea.
they're going up into the into this port.
Yeah, and is that the Black Sea, if I remember right? My geography's not always right.
Caspian. That's the
Okay,
Caspian Sea.
the Black
Um,
Sea's over to the left,
so
but it was going to Russia basically.
yeah. But their post-war export outlook depends totally on financial and diplomacy. They are
Right.
seeking no sanctions. China remains the strongest demand outlet and probably the strongest lever that Iran has, because China gets a lot of oil from Russia and Iran. And part of the reason they get a lot from Russia and Iran is both of those have been heavily financially sanctioned, and China does not have to abide by those sanctions. So a
And therefore,
lot
they
of,
get a discounted oil.
yep. And that's the reason that China is buying that, because they can buy, I don't know, 10, 20% under, maybe something
Right.
like that. So you're talking about a significant price advantage.
And folks, just for a little bit of history, this is not the first time this has happened. You'll hear people talk about something called the tankers that happened in the late 70s.
Mm-hmm.
It's the same situation with Iran. Go back and look at that. If you want some history, go back and look at the tanker wars and you'll see what happened. And it is it's an interesting bit of history. Um, the difference is the world is different now than it was in the 70s. Things happen a lot faster and a lot
Right.
more severe. And so um, if you want some history on that, go back and look at the tanker wars. And it pretty much will predict what's going to happen here.
Mm-hmm.
I I think well, anyway, that's all I'm gonna say about that. I'm not gonna give you my view on that or not. Just go back, do a little bit of history, and I know it's 50 years ago. Things change in 50 years. I get that, but human nature very seldom changes. And so just go back and take a look at that, and it'll give you a little bit more context about the things we're talking about here.
Right. Right. Okay. So Kuwait. Let's take a look at Kuwait. That's one that they went from 2.6 million barrels a day to zero point 0.6. So that was a big, big drop. So what does their strategic recovery look like? It depends totally on maritime. I mean, essentially, if we go back
Yes.
to the map, they don't have an option. I
No,
mean,
they do not.
they could deliver to Saudi Arabia this way, or Iraq this way,
But
or
they're delivering to people who already have the same problem.
exactly. So it doesn't, it totally depends on the Strait of Hormuz. So
This
there's
could be
really,
this could be nation changing for Kuwait if something
mhm,
doesn't happen soon.
yeah, yeah, significantly, because even though you don't have a massive volume like Saudi Arabia, you have a relatively small country right here that depends on those million barrels a day bringing income to that region. So if Hormuz reopens securely, Kuwait rebounds. If Hormuz remains unstable, Kuwait stays trapped. So there's really no other option. Now, the UAE just spent $150 billion on expansion capabilities. And the UAE produced about 3.4 prior to the crisis and about 2 million post. So, what does the strategic view look like there? They're the structural winner. The UAE becomes the modal post war export security, more bypass pipelines, Fujairah style loading, more, more storage outside of Hormuz, more product export flexibility, and more redundancy. And the reason why they're unique is when you look at it, they are on both sides out of Dubai and out of Fujairah. And when you look at
Right.
those two sides, they are on opposite sides. The Strait of Hormuz is right here. This is the strait. So they have a port over here and a port over here. So they're able to connect those two, and in large part they already are. But they are going to be a structural winner there because all they need to do is just do some infrastructure within the country. They don't need to coordinate with anybody, and they've pre-spent dollars on expansion of production. So, so yeah, Oman and Bahrain. Now let's go back and take a look. You've got Bahrain down here, not a big oil player or natural gas player, mainly just because of geographic size, but they are still in the region. They're going to be like Kuwait. They're totally dependent on the Strait of Hormuz. Oman is fully outside of the Strait of Hormuz, with the exception of this piece right here. That is Oman. A lot of people forget that. That is a little sliver of Oman right here. So when you look at that, it's kind of interesting. So Oman has this coverage, and they have all this landmass down here, and then they have this. So when you're looking at Bahrain, they're highly exposed. Oman is going to be relatively stable. Qatar, again, when we go to the map, where is Qatar? Qatar, they are totally dependent on the Strait of Hormuz. There is not another path. And with a lot of their shipping, they are shipping out LNG. Well, that's not something you just put into a pipeline.
Right.
That's not something you can, but you have to have very specific pipelines for that. So
Well, not only that, or you have to build the regasification or the gasification facility on another shore, and that gasification facility takes 3 years and billions of dollars to build.
right.
It's exactly what's going on. I mean, we see this in the U.S. right now.
Yeah. Okay, so post-war acceleration, shipping security agreements, formalizing safe passage agreements is going to be critical. Floating storage flexibility, having ships that hold that storage. Long-term LNG contract protection, who they sell to will need to have reinforcements. Meaning, if they're selling to China, then China would back them, say, militarily, and say, nobody mess with Qatar because China is going to step in. Alternative logistics discussions. These are going to be more nuanced and trickier because most of their exports are LNG. But the bottom line, Qatar's oil story is small, but Qatar's energy security story is enormous because they are totally dependent on the Strait of Hormuz. So
Right.
when we look, we've got Bahrain, Qatar, Kuwait. Those are the three most exposed. Everybody else has some alternatives. They may not be optimal, but they have some. So now let's look at the oil. We're going to start with the picture, and then we'll go through the text. So when we're looking at the Strait of Hormuz, here's the supply side: Saudi Arabia, Iraq, Iran, UAE, Oman, Qatar. Okay, they all go through the Strait of Hormuz, and they deliver to China, India, Japan, South Korea, and a little bit to Western markets, but most of it goes to these locations. All right.
And on the Western markets, most of it's actually going to Europe, not the U.S.
Right. Most of it is probably going through the East-West pipeline from
Yes.
Saudi Arabia to the Suez Canal. Most of it. But there was about 10% of the oil imports that we were taking from the Middle East prior to this. So there was a little bit that we were getting from the Middle East. But let's look at the.
And let's
Mhm.
let's talk about that. Most of that was coming from Iraq, and
Oh,
it is leftover contracts from the Gulf Wars.
oh, okay. I didn't know that.
Yeah.
I did not know that. That's interesting. Okay. So the common thread here: Asia is the main demand center, the Middle East is the supply center, and Hormuz is the hinge, or that is the bottleneck in between. So let's take exporter by exporter and take a look at the post-war risk. The risk is high, medium, or low. Saudi Arabia delivers to China, Japan, South Korea, India, and the US. Okay. Not a lot in the US, but a little bit. They have a post-war medium risk. Medium risk meaning volumetrically, it's a large risk because they have 3 million barrels they can't move today because of the Strait of Hormuz. So from the volume perspective, and let me go ahead and write these. So their Strait of Hormuz impact is over 3. Iraq was, what was that, 1, 2?
Yeah.
That was close to 2. Iran, basically nothing. Kuwait, 2. UAE, 1. Okay, so the reason they're medium risk is because they're taking the largest volumetric hit, but they were producing 10 million barrels a day. Iraq, they're at a very high risk because they were producing 4 million barrels a day. Iran, I'm calling that one flat. Kuwait is very high because they were producing what, 2.6, right?
Yes. Yes.
And UAE was producing 3.6. But bear in mind, the reason that they're medium is because they actually have put money into expansions. But you will see a common thread here. Saudi Arabia, China, 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 China. Right now, China is not getting this oil. So where is it coming from? Now, China's been not secretly, stockpiling. I say secretly just because they don't post the numbers. So I don't know how much, but they have a lot of barrels in strategic petroleum reserves. So another common theme you'll see here, India, 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 India. So those two countries are the largest demand centers that are impacted, along with South Korea and Japan. So, so what does this export map look like after? So before the war, Middle East moved oil by habit. After the war, Middle East oil moves by permission, insurance, military risk, and route optionality. The new hierarchy is the best positioned is UAE, Oman, and Saudi Arabia. The most exposed, Iraq, Kuwait, Iran, because of the diplomacy and financial impacts. The most strategically complicated is Qatar, because you can't just move LNG in another way. It goes into it would take billions of dollars to redesign that facility. It's going to take billions of dollars to fix the capacity problems or the capacity that was taken out in some of the strikes.
So when you look at it, oil is a logistics problem, but LNG is a physics problem. And so that's really sort of the difference.
Yeah. Yeah. Well, because we can't just load it in the same way that crude oil can.
Right.
So now we're going to step through some base case, pessimistic, and optimistic cases. And for base case, what are the assumptions? Hormuz partially normalizes. Okay. There's going to be a period where we normalize maybe to 80% of what it was, what once was. There's not going to be a full regional peace deal unless it takes a long time to negotiate. Insurance costs remain elevated. Some tankers continue going dark. This is what's called the dark fleet, where they turn off their transponder because they're taking oil from a sanctioned facility or a sanctioned country. Saudi and UAE export routes recover first, and Iraq and Kuwait recover more slowly. Iran remains sanction constrained. That's the base case, that there is going to be some sanctions out there. Now, again, for reference, you had 10, you had 4.1 here. You had Iran, which was right around 3. Kuwait, which was
3.2,
at
yeah.
what was it?
3.2 on Iran.
3.2.
3.2,
Okay.
right.
And Kuwait was what?
Kuwait was 2.5.
Like 2.2? 2.5.
2.5.
All right. And UAE was about 3.5, right?
Right.
Okay. So base case, you can see most of the recovery, limited recovery here, most of the recovery here, limited recovery here, and I'm going to say medium recovery here because that's still not where they want to be. So that is the base case. All right, that's assuming Hormuz normalizes. Let's look at the optimistic. Hormuz reopens fully, insurance costs fall, export terminals normalize, Iran gets partial sanctions relief, OPEC Plus restores controlled production, Asian refiners return to Middle East supply patterns. This takes us back, and again, you got 10, 4.2, right?
Right.
Iran was 3.2, 2.5, and UAE was 3.5. So I think optimistic, I would actually mark up UAE and I would, I'd probably take down Iraq and Kuwait. I think there's going to be some reservoir damage. So on this assumption, I would move some of the numbers, the base result I probably wouldn't really argue with. Any thoughts on this one?
Well, I think the cases are good, but it's very determined by timing.
Right. Yep.
If where we're at right now goes on for another, and you know my opinion, I think it's going to go on for another 90 days. But even it goes on another 30 days, these numbers start changing.
I've kind of come around to your school of thought. So for those that are listening to us for the first time, Bill and I debate this all the time. I thought and have thought that this would be resolved relatively quickly because of the pain and the economics and food crisis coming to a point, and it would be a quicker resolution, not a drawn out one. Bill's maintained it's going to last through the summer. I actually think now Bill may have talked me into a conversion to where I believe that it may last longer than 90 days.
These things are always harder to undo than they are to do.
Yeah. Yeah. So, all right. Now, pessimistic. Ceasefire fails. Iran continues tolling. Shipping remains dangerous. Kuwait and Iraq may remain heavily constrained. Saudi relies on Red Sea bypass but cannot fully offset. UAE uses Fujairah but still faces Gulf side limits and global inventories draw down. This, again, that's versus 10 versus 4.1 versus 2 point or 3.2.
Right.
Sorry. Kuwait was 2.5 and UAE was 3.5. So you can see some pretty big impacts here. But
So, and let's just go through this list real quick. If this continues, Saudi Arabia will increase their ability to not depend on the Gulf and not depend on the Strait. They've got the money, they've got the oil. They'll find a way around. They'll either double that pipeline, they'll
right.
do something because it now has enough money impacted that they can do that.
Yep.
Iraq is just out of luck.
Yeah.
It did. It's going to have to
Well,
negotiate with a
the
lot of countries to be
these
able to
two
get a line.
countries, these two countries plus Qatar,
Well,
because Qatar is
Kuwait's
going to
headed
be
for
LNG, right?
Kuwait is headed for probably an economic depression if this continues for a long time
Well, they may
because they
already
just
be
don't.
there.
Well, yeah, there may be. It depends on how many cash reserves they have, but I don't think they had that much. Uh, Iran probably in the same situation as Kuwait. They just don't know it yet. Um, UAE, it's got to struggle. I mean, it's going to be a struggle for them. And Oman, I think, is probably in the best of all of them. I think Oman's in the best shape.
Right, right. I can see some new alliances building, not
Yes,
new alliances, but stronger relations.
but they still got to
Um,
get from UAE, still got to get across Saudi Arabia and to get there. I think I have to go back and take a look at it to get to Fujairah. I'm not sure.
well, you've got, I think that there is going to be a participation between
Yeah,
UAE and Oman.
or that, or Oman becomes the oil broker for the Middle East.
Yeah,
That would be a whole new.
I could see that. I could definitely see that. So that's a pessimistic case. So country by country, let's look at each one. Fastest recovery, Oman, because they haven't really been impacted. UAE, Saudi Arabia.
Right.
Medium recovery is Qatar and Iran. Slowest recovery is going to be Kuwait, Iraq, Bahrain. I probably
Yeah.
would drop Qatar into from medium down to slowest, just because
They're
they've
probably
had
right on
some.
the edge. Yeah, they're probably right on
Well,
the edge.
they're able to spin up their facility real quick, but they've had some damage to the Ras Laffan LNG facility. So
Yeah. And
this is just
that's the difference here. Look at yeah, LNG.
all right. I think we had a little internet blip with Bill, but we've got the fastest recovery here, and with Oman, UAE, Saudi Arabia, and medium Qatar, Iran, and slowest Kuwait, Iraq, and Bahrain. And
People are monitoring me and they're trying to keep me from saying things. What I
maybe.
said, but what I said is when you think about Qatar, you have to really think about LNG versus crude oil.
Yeah, yeah. And I can see I'm putting on the tinfoil hat. I can see the conspiracy in that. Um,
Yeah.
so, what does this mean for the buyer side? Okay, we talked about the supply side. What does this mean for the buyer side? Asian refiners are the most exposed. China, India, Japan, South Korea. They rely on the Middle East, and they will likely diversify supply.
All right. So
Um,
let's stop. Let's stop real quick and say this. There is not a tap anywhere else that you can turn and immediately get more crude oil
mm-mm,
anywhere else.
nope.
All right. It is a process that has to be done, and it takes a minimum of 12 months for any significant supply to come online just because of facilities. And
Right.
people are not going to do that for a quote, short term, unquote situation.
Yep.
And so there is the amount of oil we have is the amount of oil we have until we have a solid increase in demand, not a shortage of supply.
Yep. Yeah. Um, well, and that means that price is going to respond, and development is going to need to be developed, and that means it's going to take probably a long time, 12 to 36 months before you really see supply. So there's going to
Right.
be an investment period, and that investment period is probably going to be driven by price first. So diversifying supply is the first task. Holding more inventory, building more buffers, buy more US or Atlantic crude, and lock for longer contracts. And this is part of the reason we developed Rogue Radar so that you could have this at your ready every single day. We provide a market narrative on crude, on natural gas. There's information and a link down below. It's a subscription to Rogue Radar. And we cover technicals, we cover fundamentals. We cover in one of our videos with our subscribers, we were just talking about crude exports. And you can see that we're 61% out of the US greater than the 3-year average and 50% higher than last year. And that's because there's a stronger market there. There's a stronger demand there. And we also take a look every single month at what's happening in the Strait of Hormuz with OPEC. And I do need to move UAE over here, maybe. So UAE is no longer part of OPEC, but this is what we're evaluating, and this is what we look at every single day. Is we look at, well, how much Russia is here. Here we are, what, 4 years into the Russia-Ukraine war, and there were talks at the beginning of the war of Russia going from 9 million barrels a day down to 6, and that they would dwindle down. What's happened is actually they're up. They're close to
Right.
10. So so we do that every single day, and part of the reason that we put these out there is to help educate people and bring people into our universe. These are the things we talk about inside of our newsletter, our videos,
Right.
and
Our,
our software, our analytics every single
our,
day.
our whole community, we're always talking about this. And we have people in our Discord channel who talk about things that we go, oh, well, that's an interesting thought process. And Brian, I'll begin to research and change it a little bit differently. Like right now, this situation, while it is probably worse for a lot of people, it's Venezuela's best chance to get their energy business back online.
Right.
And I just don't know if they've got the ability to do that.
Yep.
But this is their best chance.
So anyway, if you follow energy markets or your company is exposed to commodity prices, whether it be oil, natural gas liquids, refined products, this is going to be your cheapest and best resource out there. Okay, so what does this mean for producers? A new investment mandate. The new premium is not just low cost production, it's low risk delivery. So that's another thing that we're going to have new dynamics between WTI and Brent, where the winners are going to build more bypass or more flexibility on the Red Sea and Arabian export access. They're going to have more storage outside of Hormuz and more domestic refining so that they're not dependent on the products that are refined there, because 5 million barrels a day of refining capacity was damaged during this. So there's also shipping security partnerships, and these are going to be the key things that are going to be in the thought process for the Middle East producers. So what do we do at Energy Rogue? We break things into 3 methods. We look at visibility, velocity, and validation. Visibility, production is down. Like this tells you how we process information. Visibility, we notice that production is down. Exports are disrupted. Stocks are finite. Asia's exposed. Velocity, the shock is not static. It's not a simple stasis, stable. It's going to move and evolve. It's part of the reason when we were talking 26, 27 viewpoints, Bill and I have different viewpoints. And that's part of the reason we designed Energy Rogue, because those viewpoints are the center of finding truth. Export losses are changing weekly. Tanker movements are shifting. Globally, there's a tanker shortage because you have a lot of ships that are actually trapped in the Strait of Hormuz. Freight rates and inventory draws are evolving. And this gets back to the narrative in the market talks about the global stocks shrinking, and that is in the consuming regions. But the stocks are building in the Middle East because they're creating as much temporary storage as they possibly can. Because when a producer, for those that don't understand production out there, when a producer shuts in a well, when they turn it back on, it's not going to produce at the same level that it previously did. It's not like your water tap when you turn on the water and you turn it off and you turn it back on and it comes on at the same pressure. That's not the case with oil. And the reservoir underneath the surface flexes up and down, and it's part of the reason that when you have that flex, the reservoir may not be able to produce what it previously was. So that's the damage that can be
Or they're going to have,
happening.
or they're going to have to work over the well and do that. That's capital dollars that have to be spent.
Yeah. So we got the visibility into what's happening now, the velocity in measuring how much these things are going to be impacted, and then the validation. Physical markets remain tight. For instance, we just talked about it in our community this morning on our video. WTI is, say, $92 today. Well, physical markets in ships is anywhere from 120 to 150. So it is, the physical markets are a lot different than financial markets. And we talk about both in our community. Freight rates remain elevated. Alternative crude demand is rising. And you can evidence that just by looking at the United States exports. Because another thing we were commenting on, our exports are up 61%, or you can basically take that up that we've increased 2.5 million barrels a day, roughly. Okay, so remember that number. Then you go down and you've got distillate exports. Distillate exports are up 30%. So call that 0.5. So you got 2.5. And another thing is propane. So we got 3 now, right? Propane exports right here. That is up only 10% year over year. Okay. A lot of people may ask because we have plenty of propane stocks. We are 15 million barrels over our 3-year average. That's because we have mild weather and we continue to produce a lot. So when we're looking at these validations, we're actually validating that because the US has limited export capacity. They can't export everything they want to. So, and that's the reason that you have propane prices differing in the US versus elsewhere.
And
But
roughly 10 years ago, we weren't exporting any crude oil at all.
Lastly, stocks are going to be tested, and so what now? Saudi Arabia has the scale. UAE has the optionality. Oman has the geography. Iraq has vulnerability. Kuwait
Right.
has choke point pressure. Iran has political risk, and Qatar has LNG leverage. And that leverage works for them and against them. So,
Exactly.
the routes are going. Previously, the oil market would only look at oil production and exports. Now there's going to be a third layer, which is going to be transport. So,
Right.
as much as I said, reference this map. It's called marinetraffic.com. It's a great resource out there that tracks ships, tracks what's happening. They do have some commercial subscriptions. I don't know what they cost, but we have our own product where we actually consume all this information from around the world on oil supply, oil demand, oil stocks in different countries in the United States as well as other countries. And that's part of the reason we created Rogue Radar, to make it affordable, because most of these institutional systems cost so much money that people can't pay that for that intelligence. And that's why we condense everything into what you need to know. So you can learn more about that. If you want to learn more about how we approach the markets, how you can get market clarity in 5 minutes a day. There's a free ebook down below. But what's your landing the plane thought of the day?
Well, the first thought is listen to the headlines. Uh, my brother always says, "Well, how do you know which way it's going?" I said, "Well, if you hear the word peace in the headlines, the price will go down. If you hear the word, uh, I'll just call it acceleration or uh, intimidation, any words that says that they're going to go back to war, that's going to run the price up. That's how I listen to the headlines. Look at the numbers. If you don't have a source for your numbers, subscribe to us. We can provide you that data. And not only that data, but we'll give you insight that comes along with that data. So landing the plane is, I think this is going to go on. I think we won't see it end until sometime in late August, mid-September. And it's just going to take that long to unwind it.
Yeah.
And so even if we had a deal tomorrow, it'd take that long to unwind it. And and if you go back and look at the tanker wars of the late 70s, you'll sort of see where I'm going with this. It's not because anybody likes how it's going to end. It's
Right.
because they just don't have another choice.
Yep. Yep. You're completely right. Well, listen, folks. Hopefully that gave a good overview. If you sign up for our free ebook, you can email me back and I will send you this presentation. So if you want this presentation, get the free ebook, and then you'll have my email, and then just email me, send me the presentation on the Middle East. So I will be happy to share that with you. So listen, folks, thanks so much. That's all we got for today. I know this was a long one, but I think it was well worth it. So listen, Bill, Brian, Energy Rogue, we appreciate you. And we will see you. When are we going to see him?
We'll see you again next week.
All right. We'll see you again next week. Thanks, folks.